CrowdStrike is one growth stock down 55% that I think investors might regret not buying on this dip here. In this video, I'll explain why I think that's the case. So let's begin, starting with revenue growth. Looking at CrowdStrike's revenue growth over the recent years, you could see very robust revenue growth starting at over 100%. Of course, it's been decelerating, but still 47.88% revenue growth in its most recent update. This is even though many enterprises have tried to cut back, pause, or delay spending on cybersecurity. Although longer term, I don't think they can cancel spending on cybersecurity. Increasing attacks, cyber attacks, all of that has been a bigger threat to enterprises and institutions worldwide. Cybersecurity is an industry that's continuing to grow double digits. I believe it will continue to do that for the longer term, 5, 10, 15 years maybe, and maybe even longer than that as more of our lives become digitized and become online. More data, more financial information is going to need to be protected. And so the services of companies like CrowdStrike are going to be in more and more in demand. And that's going to be good news for CrowdStrike long term. Here's why CrowdStrike I think is really attractive as an investment is not just because of that robust revenue growth. You can find a lot of companies that are growing revenue very rapidly, but it'll be harder to find companies that are growing revenue rapidly, but also making progress on profitability and making increases in cash flows. So I'm going to show you CrowdStrike. Look at this here, operating profit margin over the trailing 12 months, going from negative close to 60% all the way up towards profitability at negative 8.48%. So look at that massive improvement in just 3 years. It would not surprise me if in the next 2 years, if it continues at this rate, the company becomes profitable on the bottom line. It would not surprise me at all because it's making such great progress in delivering economies of scale with revenue growth, and the industry is undoubtedly going to grow. And so if it continues showing evidence like it has been, it's only a matter of time before it scales into profitability. And looking at its cash flow from operations, that's already very nicely in the positive, going from close to zero in 2019 or negative slightly, and then climbing all the way up to 941 million in cash flow from operations over its trailing 12 months. It's grown very nicely over time. So you might ask, how is it that its operating profit is negative but its cash flow from operations is positive? This is not an uncommon thing for tech companies to have this diversion between cash flow and profits, and it's because many tech stocks like CrowdStrike use a considerable amount of non-cash expenses, the main one being stock-based compensation. So when they pay their employees in stock-based compensation, it's a non-cash expense that deducts from profitability, but it doesn't deduct from cash flows. So for that reason, the company can show positive cash flow from operations while being negative in terms of profitability. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So the final reason why I think you might regret not buying this dip in CrowdStrike stock is because of the favorable valuation. Looking at a forward 1-year price to earnings ratio, CrowdStrike is trading at a forward PE of 43.77, which is near the cheapest that it's been going back roughly 2 years. And given the rapid growth of this company and the acceleration close to operating profitability and cash flow from operations, I think it's worth this premium valuation. A forward PE of 43 is not cheap in and of itself. It's only cheap when you compare to CrowdStrike's own history. It's not cheap when you compare CrowdStrike with all of the other stocks in the market that exists. 43 is a premium valuation. But investors should be willing to pay a premium valuation for a company that's got such excellent prospects the way CrowdStrike does, operating in an industry that's growing by double digits, expected to grow that way for several more years into the future. The company itself growing revenue more than 40%, demonstrating economies of scale, demonstrating increases in cash flow from operations. All those positive metrics deserve a premium valuation. So for all those reasons, I think CrowdStrike might be one stock that you might regret not buying on this dip here. Alright, so that's all I've got for this video. Thank you for watching. I've picked some videos that are popping up on your screen. Please click one of those and I'll see you over there.